Growing pressure to ease Germany's COVID curbs, her finance minister becomes the latest official to call for a quicker reopening. Good morning, everybody. So just 20 seconds to go until the start of European equity trading, and futures do point to the downside. We saw really strong gains in yesterday's session, so perhaps no surprise there. But US futures, incidentally, increasingly negative, actually, as we go through this morning, the early hours of the morning here in Europe. NASDAQ futures now down by 0.7%. European equity market futures point down by between 2 and 0.3%, as you can see on that screen. So as we get these European equity markets open, we've got a few individual stock stories to watch out for. We mentioned Danone and Taylor Wimpey. We'll also keep an eye on the share price of Lindt and also Boohoo, based on some news flow that we've seen around those businesses. So we'll keep an eye on all of that. The London market just opening to the downside, down around 0.3%. As I mentioned, US markets to the downside, or at least the futures are to the downside. And the Asian session was weighed down a little bit by some of these comments that we heard from the Chinese banking regulator, talking about fearing bubbles or warning about asset bubbles. It seems to have touched a nerve with some global investors. He was talking about foreign markets and Chinese property markets. So European equity markets on the back foot this morning, down 0.3% then on the CAC 40 and on the Xetra DAX. Most Asian stocks slip along with US equity futures, as we've been saying. That's as investors weigh the impact of the recent climb in bond yields and of those Chinese comments, warnings around asset bubbles. Joining us now is Shanti Kellerman, Brown Shipley Investments Director. Shanti, a very good morning to you. Let's start with these warnings about bubbles, because it does seem to have touched a bit of a nerve through the Asian session. We've got some weakness in the Asian session as a result of these comments from the Chinese Regulatory Commission chairman. How concerned are you about the types of bubbles that he's flagging?
So I think we actually see Asia and China in particular as a region that's very strong at the moment. And we also think their government has shown they're very competent in managing issues that they have in their economy. They've dealt with, soaring property prices. They've dealt with their shadow banking sector. Not completely resolved, but they've made a lot of progress. So I think his comments, it's good to be vigilant, but I don't see them as changing our fundamental outlook. China is growing very strongly. I think as the US, UK, and Europe start to have more of an economic recovery, that will only increase the demand that we have that's fueling China's economy.
So you don't see the recovery in Europe, the recovery in the US as a sort of rival to the Chinese investment thesis that you like, Shanti, because I see that you're overweight emerging markets, and within that, I understand, overweight China.
That's correct. So I think they've obviously controlled the virus very well. Their consumer spending is quite strong. But what we think is that as the US gets stronger, as Europe gets stronger, it's only going to increase demand that they have on their manufacturing sectors. So we think it will work in tandem to strengthen China's economy as the US economy gets better. Other things we like about Asia when we look at it are low external debt levels, inflation is fairly under control. Those are things that give them space to act in the policy sector if they need to, relative to other emerging market economies that are weaker in those areas, particularly in places like Latin America and Africa.
We are continuing to watch what's going on in treasury markets, of course, Shanti, and we've seen, of course, yields were climbing last week. We've paused a little this week around that 1.4% mark.
Good morning, everybody. Hope you had a good evening. If you're up to British pound, I'm looking to sell short British pound. And the price I'm looking 138.79. So if you're looking to sell at 138.79, you can just copy this trade, follow me, and then you can collect the profit. It's as easy as that. Okay, it's probably not as easy because it will take time. You need to know when you do this. So I place the order, 138.79 at British pound, and I'll speak to you later.
Reason to view it positively. If it's something related to runaway inflation concerns, then that would, of course, be a negative, but I don't think we're anywhere near that stage at this point.
Yeah, thinking about runaway inflation concerns, you don't see then the push up in commodity prices as worrying or flashing up red on your radar when it comes to inflation. We've been thinking about oil prices, about copper prices, about more broadly the metal space, and food price inflation for some emerging markets as well. Shanti, are you concerned about that?
We expect there to be a moderate rise in inflation, and we think that's healthy. We don't want inflation at 0 or 0.5%, as we saw for some portions of last year. I think we will see inflation figures rise just from things like, for example, when VAT taxes are going up in Germany. So we'll probably see that feed through their numbers. The high oil prices will come through. But those increases will be moderate, and we believe central banks will look through any increases in inflation as temporary, and they'll keep interest rates anchored at low levels to support government borrowing, to support the recovery. We think that's going to be their main aim.
Shanti, stay with us. Shanti Kellerman, Brown Shipley Investment Director. Thanks very much for your thoughts so far. Coming up on the programme, we talk about the vaccine passport debate as they come closer to being a reality in parts of Europe. We get the details from Brussels next. This is Bloomberg.
Okay, guys, position opened at 138.79. Short position.
Are you?
I'm a leader that works on figuring out destinations that we should aim for, and then chooses the direction.
We're still getting up to full speed. So although the sales environment has been strong, it'll just take another few months to get back to sort of normal levels of production across everything. I think day by day at the moment, we're building houses at a very normal rate because we've learned how to do it in a COVID environment. But, as I say, there's still a bit of a catch-up because most of the processes slowed down for several months last year.
Pete Redfern, the Taylor Wimpey CEO, speaking to me earlier this morning, talking about the extent of the recovery from disruptions of last year, where they are seeing that recovery, and the demand environment, which he seemed to look pretty favourably on. Taylor Wimpey's shares up by just over 3%. And interesting to see the market pulling back, though, from those levels we hit yesterday. Really strong gains for European and US markets yesterday. But we do pull back from those levels. You can see the energy and basic resources sectors are certainly the worst hit today. Now, let's focus back in on the UK. ahead of the budget tomorrow. Shanti Kellerman, Brown Shipley Investment Director, is still with us. And Shanti, your thoughts on the UK asset space then right now as we head in towards the budget? Clearly, some of the home builders have been boosted by some of the policy direction that we hear about from the UK government this week. You've recently added UK small caps to some of your portfolios. What's your investment thesis?
So I think there's two different things to talk about. One is some of the stuff that Rishi Sunak might do this week. We think that it's possible a small rise in corporation tax could be likely because it's something where corporation taxes are lower than the rest of Europe. We think things like implementing a wealth tax would be very complex. And we also don't think the government will touch things like national insurance, income tax, or VAT, as those are in line with the Conservative government's pledges. On the other side of it, UK small caps, for us, we view that more as a play on the global economic recovery. Small caps have been an area that's outperformed recently. They lagged last year. And UK small caps are actually fairly global in nature relative to European or US small caps. We also thought the fact that the Brexit sort of risk premium will recede this year is another tailwind. And also we have some strength that's been coming through in the pound. So for us, UK small caps is more about a play on that recovery of the global economy and the UK economy as well.
And I suppose if you're looking for UK exposure, the small caps helps you get around the maybe over-reliance of larger indexes on certain asset classes, on certain sectors. And we see that today with the London market. Obviously, European equity markets in general are selling off, but the most under pressure sectors today are those connected with commodities, with basic resources, with energy names. Are you interested in those spaces at all, Shanti, then? If you're looking for small cap exposure, are you interested in those broader commodity plays around basic resources and oil?
We do have some select exposure to things that are in the mining sector and the energy sector. I think if you invest for UK clients and you're looking at that FTSE index, you need to have some exposure in that area. We think there is room for the oil price to rise further, simply because as demand comes back, that should cause some natural rises, although it's unlikely to be as steep as what we've seen over the past few months. Areas like copper and iron ore will be a bit more dependent on emerging markets and China's recovery, because that's been driving a lot of the demand. That trend can continue, especially if demand picks up in China. And then the other issue you have in that space is it takes a lot more time to bring supply online for some of those things like iron ore and copper. So it takes a bit longer for those markets to rebalance than things like oil, where you can get, relatively things like shale and stuff can come back online much sooner.
And a lot of people talk about those businesses, those cyclical businesses, as being ones that might benefit if we pivot away from growth and more towards value, Shanti. And the reopening trade links in with that a little bit. How do you play the reopening trade at this point? How far through that do you think we are?
So I think largely what we've seen so far is the sentiment phase, where when we had the announcements about vaccines coming out last November, that shifted sentiment for a lot of those cyclical companies. We haven't actually gotten to the phase where we really have sustained economic improvement and the economies have broadly opened up. So that's what we need to see next. We're not going to see a full recovery in the value sector on sentiment alone. At the same time, I think the growth stocks can still do well even as the economy reopens. A lot of those companies have, very stable revenue streams, linked to structural long-term factors in the economy. So at the moment, our portfolio, we don't have a sort of tilt to one or the other. We're trying to keep our exposure balanced, and it's more about finding the companies and the opportunities within each of those sectors.
Shanti, thanks so much. Thanks for joining us this Tuesday morning. Shanti Kellerman, Brown Shipley Investment Director. And Shanti will actually be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Now, let's head across the channel now. EU health ministers were told on Monday that they need to ramp up coronavirus vaccinations. This as the bloc draws up plans for vaccine passports that could ease a return to normality for those who have been immunized. Meanwhile, German Chancellor Angela Merkel faces further pressure to ease the lockdown after her finance minister, Olaf Scholz, called for a quicker reopening. Joining us now with more, Maria Tadeo in Brussels. Maria, take us through some of the latest headlines that stood out for you then.
Well, Anna, you know, the big conversation here continues to be the summer season, whether or not that can be salvaged and whether or not we'll need to show a certificate. And what is new here is that the Commission now says is working on the first step toward that. And it's something that they like to call a digital green pass that looks very much like a certificate to me, in which you'd be able to show whether you've been vaccinated and you'll also be able to show whether you've tested negative. And they say with this pass, this is really the first step towards mobility in the EU 27, whether you're looking at that for work, but also for tourism. And if everything goes according to plan, and that's a big question, it would be operational in 3 months, so meaning right before the summer. Now, what is interesting, Anna, here is that all of the discussions about vaccination and potentially the certificate towards the summer, it's very much about the EU 27. It's very much about countries that are member states of the European Union. There are virtually no mentions to countries outside of the EU, and that could get problematic, because I also hear, and we've talked about this on the show many times too this week, that Southern European countries are now saying you have to look at the United Kingdom. The United Kingdom has got to be part of that list. If there is no consensus around it and tourists are not able to come into countries like Spain or Greece, then they would look into bilateral solutions. That means, you know, one-on-one deal with the UK, which of course in the context of Brexit could be politically very delicate.
Okay, Maria, thanks very much. Maria today with the latest there from Brussels, a number of news lines to keep an eye on then in terms of the reopening story for various European countries and the role of passports and vaccination. Coming up on the programme, more from our exclusive conversation with JP Morgan's chairman and CEO, Jamie Dimon. He talks about the case for targeted US stimulus, the vaccine rollout, and whether his employees should get the vaccine. That is next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Welcome back to the European Market Open this Tuesday morning. European equity markets staging a very quick recovery, 18 minutes into the trading session, and we are now in positive territory on all of these major European equity markets. The media sector acting as a little bit of a counter to the weakness in the basic resources and energy space. Now, while JP Morgan's Jamie Dimon would like the bank's employees to get the COVID-19 vaccine, he said it's unlikely it will require the shots, at least for now. Bloomberg's Ed Hammond spoke with him exclusively.
getting through COVID is absolutely critical, and we're still in it, though God knows it looks like there's light at the end of the tunnel, by the beginning of the summer or something like that. And it's not a binary subject. I think, Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. Women who had to go home, who basically stopped working because they had to go take care of something like that, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? And we just throwing money at people at one point. And there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it too much.
But isn't the risk exactly that if you have places and states, people that don't need help and getting the help, you overflood the system, you do create this huge risk of inflation.
Yeah, and the system already has a little bit of that. So if you look at what's in the system, it looks to us like there's $1 trillion, $1 trillion that's unspent. That's before this $1.9 trillion. So there will be money, there's a very good chance you're going to have a gangbuster economy for the rest of this year and, easily into 2022. And the question is, does that overheat everything? And we just don't know yet. But I would put that on the things to worry about. I wouldn't worry too much about it. I would worry more about COVID and nuclear war than I'd worry about that. But I would suspect there's a pretty good chance you're going to see rates going up and, people starting to worry about that at one point.
Let's talk about COVID for a second.
I've been very clear. I would not buy 10-year treasuries, just so you know.
On COVID, we are obviously doing this interview in person, which is fantastic. We're doing it in your offices here in New York, but still largely empty, as are my offices, as probably are a lot of people's offices. How important is it to a business like JP Morgan to actually have people physically coming back to work?
It's very important. I do think there'll be part of the world where a certain amount of people work from home permanently, certain sales, certain ops, so you can track the productivity, et cetera. I think there'll be a large portion who permanently work in the office. Think of our branches, cash management, probably most of the trading floors, et cetera. And there'll be some hybrids where you spend 2 weeks at home and 2 weeks in the office, or 3 weeks at home, a week in the office, or 3 days and 2 days and 2 days, 3 days. But so I think it will reduce the need for commercial real estate, but there are huge weaknesses to the Zoom world. Most of us learned by an apprenticeship system, by seeing mistakes, going to trips, how do you handle a client, how do you handle a problem. So it's hard to inculcate culture and character and all those things when you have the Zoom world. Spontaneous combustion, it goes away. Hard to manage. It's hard to be very critical. You got 15 people on the screen. So but before it was like a deep dive question. Now it looks a little bit rude. And I took a trip to California and met 100 people all outside, all wonderful, breakfast, lunch, and dinner. It's amazing how much you learn about your own business, your own bankers, your own clients, your own products. And, I met with Snowflake and Marqeta. What you learn about technology and systems, you're not going to do that in the Zoom world. And, so bankers, relationships. I think it's very hard to build and develop and deepen a relationship on the Zoom world. So you still, there'll be more Zooming. People like me will travel just as much as I did in the past.
As and when the vaccine does become available for your workforce, will you make it mandatory for people to take it if they do want to return?
It's hard to make it mandatory. And there are laws about that. I think what we'd like to do is kind of have carrots and sticks. We want people to take it. I think it's a far better thing. You certainly can't make it mandatory before it's fully accessible. So that question can't even be answered until June. But I do think you may see some companies do it. I can see an airline doing it or a hotel company doing it. I can see some people saying if the folks in our branches aren't vaccinated, they're not going in. So there will be pressure. And I would say carrots and sticks, not mandatory.
Carrot and stick, not mandatory. The view there of JP Morgan Chairman and CEO Jamie Dimon speaking in an exclusive interview with Bloomberg's Ed Hammond. Catch more of that conversation throughout the day. We're bringing you plenty of it here on the European Market Open, and we'll be bringing you more of that conversation with Jamie Dimon as we go through programming here at Bloomberg TV. Let's get a Bloomberg Business Flash for you right now. Here's Laura Wright.
Thanks, Anna. China's top banking regulator is very worried about risks from global markets. He says bubbles in the US and Europe could burst because their rallies are heading in the opposite direction of their underlying economies. He's also concerned about China's property bubble, saying buying homes for speculation is very dangerous. Zoom thinks it can stay a part of daily life even after the pandemic ends. Investors fear the software maker cannot continue the growth it's seen during the pandemic, but the firm is predicting increased increases for 2022 as well. Zoom is trying to diversify and could add new cloud products to appeal to more business customers. Lex Greensil's plan to transform his trade finance business into a global giant is falling apart. Credit Suisse is freezing a $10 billion family of funds that invest in loans sourced by Greensill, citing uncertainty over the valuation of some of the debt. SoftBank is another backer signaling doubts about the loans. That's your Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London with your Business Flash. Let's take a look at some of the stocks that are on the move. Speaking of businesses that are newsworthy, Danny Berger is here with a look at some of them. And Danny, we've got a range of sectors for you here.
Really doing a range of earnings and various other news stories. Taylor Wimpey, a second day of gains. In fact, it's on track for its biggest two-day winning streak since November of last year. Yesterday, it was about that 95 mortgage plan coming from the UK. Today, it's all about their earnings, beating expectations, reinstating dividends, and the technical numbers looking strong too. Analysts pointing out that margins coming out of Taylor Wimpey also are impressive, beating expectations. So those shares up more than 3.3%. Let's look at some of the stocks on the downside though, and one of those to move lower is HelloFresh. That also reported earnings, and the earnings were extremely strong for 2020. We knew this was a trend, more people ordering online for their food. However, it's the view forward that perhaps is injecting this pessimism into the shares. They see the growth not happening as quickly, perhaps because we're getting some normalization in the world, and margins also worsening, seeing EBITDA margin around 9 to 12% for the fiscal year of 2021. Now, the other company in the headlines for the wrong reasons is Boohoo. Shares sliding in today's trading. Sky News is out with a report that the U.S. might ban imports from Boohoo over concerns of use of slave labor. Sky saying that the U.S. Borders control there think they have enough evidence to seek charges against Boohoo. I want to take a quick look at what the macro market looks like. It's definitely a day of taking a breath after what yesterday felt like a risk-on sprint. You can see behind me, Stock 600 not really moved. Neither are 10-year yields. Those are pretty at a standstill, but oil falling ahead of the OPEC Plus meeting this week. Anna?
Okay, thanks very much. Should say, Danny, thank you for that. Should say that Boohoo saying to Sky that if they discover any suggestion of modern-day slavery, they would immediately disclose this. So we'll see where that conversation leads. Coming up on the program, Man Group defies the hedge fund investor exodus with a year of overall inflows. We're going to be speaking exclusively with the CEO, Luke Ellis, about the outlook for the world's largest listed hedge fund. That conversation coming up next. This is Bloomberg.
This capture can be integrated into games, teleconferencing applications, education platforms that are built with the standard 3D content creation software.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. 30 minutes into your European trading session. And European equity markets have been either side of the flat line so far this morning. They seem to have settled just below the flat line once again, so making some modest losses, down by around 0.1%. US futures have been pointing to the downside and continues to do so as we go through the early part of the European trading session. The yield on the US 10-year just ticking up that little bit, 1.42%, but not making the moves that we saw in last week's trading environment. That is for sure. Now, Man Group, the world's largest publicly listed hedge fund, defied a wider exodus of capital from the industry by raking in $1.3 billion of client cash in the fourth quarter. That influx helped lift assets to a record high, and the company's CEO says he's confident in the growth trajectory and has entered the year with good momentum. Luke Ellis is the Man Group CEO, and he joins us now for an exclusive conversation. Luke, very good to speak to you. So looking at these numbers then for the fourth quarter, raking in $1.3 billion in client cash in the fourth quarter. What do you put that down to?
Well, in the end, these things are put down to having very good relationships with your clients and about delivering high quality products. You know, I'm super proud of how the Man team dealt with 2020. The year through sort of pretty much everything at us that it could do, and we came through in a sort of very resilient way, business as usual. So we've got farmers, as you said, at the highest level it's been. We've got records across most of the things. We had net inflows. We beat estimates. We're pretty happy with the momentum we have within the business.
You're clearly, you have many parts to the Man Group business, a diversified business. Quants and computer-driven hedge funds are part of that conversation. I wonder if you can tell us how that side of the business has been faring as we've gone from 2020 into 2021. Last year was a difficult year for many in the quant space.
Sure. Look, I think what's really important is the diversification we've built into the business over the last 5 years, so that, you know, in the nature of markets, and particularly when they're as volatile as they were last year and seem to look like they're going to continue to be in 2021, you know, that suits some of the strategies, doesn't suit some of the other strategies. We are very technology focused across the firm, either in the quant side or using it to help the discretionary side of the business, letting the humans focus on the bits where they have an edge rather than collecting data. Our quant side, basically the directional side of the quant stuff, so the stuff that came out of originally as CTA, had a very good time last year. Basically did a good job of managing in the crisis, and then did a good job of capturing the returns that were available in the fourth quarter. And that business continues to be in very robust shape. The hard thing for quants last year was around equity factor investing. That was much harder last year, but it feels like the pressure's come off that coming into 2021, and it's starting to be a more normal environment for factors.
Yeah, I mean, Luke, what has the business learned about operating those kinds of funds during a pandemic? I mean, it must be so incredibly difficult to model something like a pandemic. So far, been once in a century event. How has the business learned, do you think, about how to deal with that kind of phenomenon?
Well, I think the interesting thing is the market effects when they happen during the course of that. You know, actually the models coped really rather well with. And, you know, while we all feel that and, you know, from a personal point of view, it's been a once in a, whatever it is, 100-year experience. From a market's point of view, it happened quickly, but it was relatively normal. So the models did a great job of getting out of the way of trouble as the pandemic hit, and then got into risk as the year progressed. I think the really interesting thing for quants is now where, obviously a lot of models look at 1-year data. And right now, 1-year data is extremely volatile based not on what's happening today, but basically based on what happened a year ago, and whether that's in the data or out of the data. So, we're doing a lot of work to make sure that the models understand what is likely to repeat and what isn't likely to repeat, and don't get caught up by events from a year ago.
Yeah, really fascinating, those comparisons year on year for many lines of work, and yours not least. Let me ask you about the discretionary trading unit then. Are clients returning to the sort of more expensive funds, the higher alpha funds, or is it more about the more commoditized products? What are you seeing appetite for?
Well, so we don't do the passive stuff and the quasi-passive. I think passive is a very good investment for many clients, and if you can get your investment returns out of pure passive on a forward-looking basis, that's a good thing to invest in. We're in the high alpha business, and while the fees might be higher, we think the value is very good in things where you have high alpha. It's a sort of index plus a smidge stuff, which is bad value. What we've seen is, there is definitely demand for high quality, long only, high alpha product. And then importantly, what's coming through with all the concerns in the bond market is basically the demand for the sort of lower risk bond return, bond risk type of liquid hedge fund is, looking a very good alternative for clients compared to, most people are sitting looking at their bond portfolio, scratching their head.
Yeah, I wonder how that rising yield environment looks to you, and you've given us a bit of insight there, Luke. We spent the last couple of weeks talking about yields on US Treasuries going higher, and I wonder what that is doing to the conversation with clients and what they're looking for.
Well, I think, from a client point of view, you could see that they're all staring at their bond portfolio and worrying. The big thing is people, in the end, why would you own Treasuries at one and a bit? Why would you own European government bonds at essentially zero yields? Well, the main reason you're owning it is as a store of value and a diversifier to your equity portfolio. The interesting thing we've seen in the last 4 to 6 weeks is the correlation between bonds and equities is definitely changing. Interestingly, it's very easy to forget. The last 20 years, we've seen bonds and equities be negatively correlated, but essentially for the previous 200 years, bonds and equities were positively correlated. And clients are now looking at their government bond portfolio, worrying whether it's going to give them the diversification, and are looking for other alternatives that might give them the diversification they're looking from something or the stable yield without having the correlated drawdown.
One of the other things we've talked about a lot on Bloomberg TV recently, Luke, has been the rise of retail investors, the GameStop, the Reddit phenomenon. Clearly, I'm sure something that you've heard a lot about. In terms of how this rubs up against your world, clearly the Reddit crowd have had a lot to say about hedge funds in recent months. I wonder if this has led to any kind of reevaluation from your perspective about short positions and about the risks associated with short positions.
So, we believe that shorting has a valuable function for the market. And, we only in Europe have to look at Wirecard, and without the shorts, that fraud would have gone on for a lot longer. I think shorting provides a useful function for the market of getting securities to their natural level quicker, and that makes markets more efficient. I think being short something where there is very high open interest, short interest, is it's at best an extremely high-risk strategy. We tend to be very careful about not wanting things which have high short interest, because you're always subject to a squeeze if that happens. It's unusual that the squeeze comes from retail, and assuming it did come from retail, but you're always subject to a squeeze. So we tend to be looking at ideas where other people aren't trafficking in the same idea. And so therefore the short interest tends to be significantly lower. And then, shorting requires very good risk management skills, and you have to be able to change your mind quickly, because otherwise you can get stuck in a position and be squeezed in the way we've seen. We're very proud of the way that we manage risk here. We have an excellent trading desk that we've really concentrated on using technology to make sure we can get out of positions very, very efficiently without the market seeing our footprint. And then shorting is a very valuable function to bring both to the market and to client portfolios, because you can give them a more pure alpha source.
Luke, really good to speak to you. Thanks for spending time with us here on Bloomberg TV. Luke Ellis, the Man Group CEO. Coming up on the programme, our weekly segment where we take a look at the world of private capital. Danny Berger is going to be here speaking with Nikos Stathopoulos from BC Partners in this week's Money Undercover. That is next. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
The President and I are pushing the United States Congress to finish passing our American Rescue Plan, so cities have the resources they need to innovate and replicate the best ideas. This plan includes critical support for those communities that have been hardest hit, keeping small businesses open and first responders on the job.
Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through it, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? You know, and we just throwing money at people at one point. So, and there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it.
That was Vice President Harris and JP Morgan CEO Diamond speaking about stimulus with us on Bloomberg a little bit earlier on this week. Now, global buyout activity is on a tear this year. Through February, deal value is 60% higher than the average start over the past 5 years. So that's pretty strong. That is according to new research out from Bain & Co. this week. With this week's Money Undercover conversation, let's get now to Danny Berger, who has a guest. Danny.
And thanks so much. Joining me now is Nikos Stathopoulos, partner and executive committee member at BC Partners. Nikos, first off, thanks so much for joining. And in that deal activity volume that Anna was talking about, it does feel like there are a lot of family-owned names that have been coming up. So you think of someone like Panini or even Birkenstock that over the past week have been looking towards buyers. Why would we see this environment now where family-owned businesses want buyers?
Well, good morning, Danny, and nice to be here with you again. I don't think it's such a new phenomenon, really. I think we see it a bit exacerbating now post-crisis, and maybe it's a bit heightened at the moment. But we at BC have been seeing this for the past at least 2 decades. I can give you a statistic that in the last 10 years, for example, about 50% of the deals we did have been with families or founders. And just in the last 3 years, about 80% of the deals have been from founders and families. And I think this is driven by a few things. One is, in most cases, there is a succession issue for some of those. So they feel that actually selling their business can solve this, partly at least, if not totally. Secondly, we've seen in some markets, like in Southern European markets, private equity is becoming a bit more mainstream, it's becoming more knowledgeable, and therefore founders and families are more comfortable selling to a private equity fund. And I would say thirdly, the IPO markets have been a bit more choppy, so we've been a nice source of alternative solution for these families.
So if that's the environment that makes families want to look at this option more and look at private equity more, how do you at BC take advantage of that? Do you push that 80% of businesses being family owned even higher from here?
We will try. It's not always easy because, of course, it's a question of supply and demand. So there's certainly the demand is there in our industry with more than $2 trillion still to invest, but we need the supply and we need these families to be willing and able to sell their assets. What we try to do is we try to use our network to meet all these families, to tell them why we think private equity ownership of their company will be valuable and will be the nice next step, and frankly, why we can be good stewards of their business for the next few years.
Of course, it's not just family-owned businesses that are looking at partners. Private equity in sports has also been pretty big over the past year. Bloomberg, we've reported that Bundesliga, the German football league, is looking for minority stakes in their broadcasting rights, and that BC has been one of the firms to look at this. So is that something you're still interested in, and why?
We are still interested, as we've been interested in sports for a while now. I mean, the way we are approaching sports investing is more from a content perspective, that I find sports as being an extremely valuable source of content. It's real time, it's unique in most cases, and that content has value. So ultimately, I think our industry has realized that, like in the case of music, like in the case of movies also from that perspective, sports has a very attractive content that can be monetized, whether it's through a club or through a league. I think it's less relevant, and it depends ultimately what will be available. And I think that monetization of the content will be a trend that we will probably start seeing more. Sports is an industry which is not very institutionalized, and I do think that the private equity industry can be a bit of a catalyst in institutionalizing what is a very attractive industry, frankly, and certainly growing.
You mentioned the difference between the league and the club. I know Inter Milan's another one that's been in the headlines. Is that an opportunity that you're actively bidding for at the moment as well?
I cannot comment on deals that have not actually happened, as you can imagine. But certainly we have been exploring also investing in the sports industries, as I mentioned, both through the league and through the club ownership. And ultimately, club ownership has to be with a club, in my mind, that has also very high probabilities of competing at the highest level of competitions.
How does the growth of Netflix, Amazon, of course, they look at live programming too. How does that change the value of these different potential sports content deals?
I think it's great examples of exactly the type of assets that are growing. And it's a good example, of course, that you need to invest in that content if you're willing to monetize it and to try to maximize value. But I think the likes of Netflix, etc., have shown that institutionalizing a certain sector and the content can become very, very valuable. If you look at the value of Netflix today, of course, there's no comparison to the value of any sports club, regardless of what type of sport, whether it's football or basketball or any of the biggest sports in the world.
There, of course, does tend to be concern when you get private equity deals in sports leagues that perhaps, you know, the majority of it goes away. It gets away from being sort of a local club. Quickly here, Nikos, how do you sort of alleviate those concerns when it comes to sports deals?
I'm not sure that's that big difference, frankly, of being owned by private equity or partially owned by private equity, because most transactions to date, at least, on a league level, have been for a minority stake. So private equity will be coming as a funder of capital, potentially bringing some more professionalization, some more discipline, some more institutionalization in leagues and in clubs that tend to be mostly individually owned today. So I don't think there should be any concerns on an industry that has proven to be bringing discipline to any sector that it has been investing in the past, really.
Right. Well, discipline definitely fits with the whole sports theme in general. Nikos Stathopoulos, BC Partners Executive Committee member and partner, thank you so much for joining us. Anna?
Danny, thanks very much. Thanks for bringing us that interview. Coming up on the programme here on the European Market Open, concerns over shortages in goods from copper to sugar have helped send the Bloomberg Commodity Index surging. So we're asking this question: how sustainable is the commodities rally? We'll put that to Laura Cooper, Bloomberg Markets Live macro strategist, who joins us next. This is Bloomberg.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
During this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open, 53 minutes into what is now a positive European trading session. We have been either side of this flat line this morning, but for now we settle at around 0.1% to the upside. The stock 600 at least. A little bit of underperformance coming through at the periphery, but essentially most of these European equity markets flat are positive. Most Asian stocks slipped today after China's top banking regulator said he's very worried about risks emerging from bubbles in global financial markets and the nation's property sector. Joining us now, Laura Cooper, Bloomberg Markets Live macro strategist. Laura, what kind of message do you think the Chinese are trying to send when it comes to this conversation around bubbles that did seem to take the edge off the Asian session?
Well, I think there's kind of two components to this. So one, the fact that worried about kind of risk in China's property sector does potentially tilt towards kind of this renewed focus on deleveraging at the National Congress this coming weekend. But I think more globally, the reason why we saw this sapped sentiment on these comments is because he is warning that what the euphoria that we're potentially seeing in U.S. and European markets is at odds with the directions of their underlying economies. But I think, we're seeing a fairly muted, obviously short-lived response to this because we have seen these bubble narratives brew up before, and policymakers on this kind of area of the world are largely dismissive of this. Yes, they see pockets of froth, pockets of exuberance, but ultimately they don't see bubbles. And so last week, after this kind of bond rout has really shaken some of that froth of equity markets, what we're seeing is investors refocus back on that reopening trade. So that's why we saw just that strong bounce yesterday, and that does look to have legs in the week ahead.
Just a quick word on some data breaking across the Bloomberg terminal, Laura. German unemployment rose by 9,000 in February. The estimate was for a 10,000 drop, so that does not seem to be moving in the right direction. Just thinking about where we've headed in our conversation and thinking about bubbles, and I know the question of the day that we're asking is around commodities and where we head more broadly on the commodity story. Where do you see commodities? How is the conversation evolving around commodities, and how sustainable is the rally? We see some steam coming out of it in today's session.
Well, certainly, commodities are under slight pressure today, but I think really just the fact that it has been quite broad-based does suggest that there is room to run. We have this perfect storm of tight supply constraints. We have supply chain disruptions really boosting agricultural prices. And then we have just this broader inflation hedge against the stimulus backdrop that is supporting the commodity space. Now, in terms of longer-term sustainability, I do question whether this momentum can be sustained, and I think that's largely reflective of the Chinese story. So in the past super cycles, we had China as a strong demand impetus, whereas this time we are seeing that Chinese credit cycle start to turn. Okay. So it could be the case where China actually drags on demand.
Okay, thanks so much, Laura. Laura Cooper, Bloomberg Markets Live macro strategist. That is it for the European Market Open. Surveillance Early Edition is up next. European equity markets fairly flat now this hour as we get that underwhelming data on German labour markets this morning. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
There are a lot of people suffering who need help. Get us through the problem, get the country going, but try not to overdo it.
K-shaped recovery is not acceptable. That's the bottom line.
Survival is not the end game. We want our cities and our countries to thrive, not just survive.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance, the early edition on Tuesday, the 2nd of March. I'm Francine Lacqua here in London, and here's what's coming up on today's program. China's top banking regulator says he's very worried about frothy foreign markets while stocks and futures slip. We'll discuss that with our chief Asia economics correspondent. Not buying treasuries, Jamie Dimon tells Bloomberg exclusively that U.S. debt is not attractive to him at these levels. The JP Morgan chief executive is keen to get staff back to the office. More of our interview throughout the program. And making London competitive, the UK Chancellor Rishi Sunak wants listing rules in London to match New York and the continent to attract more IPOs and SPACs to the city. The LSE director Minouche Shafiq joins us shortly. Now let's get straight to our top story. And the stock rally has ebbed this morning after yesterday's 2.4% surge in the S&P 500. Well, Jamie Dimon has told Bloomberg that he would not buy treasuries at their current level, but the Fed is continuing to play down the rise in bond yields.
I think we obviously have control of the yield curve at the short end. And at the longer end, I think when it moves, it depends a lot on the driver. If the driver is normalizing inflation expectations, that's welcome. If the driver is, as it seems to be, news about vaccines or news about health of the economy or news about fiscal stimulus, then I think it's a natural reaction.
Well, let's now get the view on the markets with our Danny Berger. Danny, there's quite a lot of news to digest. First, Jamie Dimon interview, but also really the Chinese banking regulator going pretty strong this morning.
Yeah, and I think that has started to fuel these concerns of what's happening in the market. And if we can go ahead and look at what the markets are doing, there is some declines. It feels like yesterday's risk-on sprint that we saw in equity markets is at least just taking a breath. So Europe Stock 600, it's been back and forth all morning. Gains, losses now basically unchanged. But those concerns of are things running too hot? Are valuations too high? Definitely showing themselves through the S&P 500, despite the fact that bond yields are more or less unchanged this morning. So the story isn't necessarily right now, at least, that sell-off in bonds hitting equity markets. Finally, though, we're also seeing crude tumble lower more than 1%. That's ahead of the OPEC Plus meeting. So when you look at some of the negativity in Europe. It's really the energy space that's getting dragged down. I want to show you, though, while we're talking about is there too much optimism? Is there too much euphoria in markets? Quickly, I want to show you this Bank of America chart because this is their sell side indicator. So this white line, the higher it is, the more optimistic the sell side is, the lower it is, the more pessimistic. The idea behind this is it's a contrarian indicator. Once it touches this line, which is one standard deviation of the average, it's a sell signal. People are too optimistic. Bank of America now says we are 1 percentage point away from that threshold. And Francine, this is a really good indicator, at least it has been in the past. Last time we crossed this threshold was June 2007. It did not go so well after 2007 when equities fell about 13% over the next year. So if you want another reason to be fearful of the market, Bank of America has you covered here.
Danny, thank you so much. I'm sure they do have us covered in terms of concerns out there to watch. Now, sentiment took a further hit after the chairman of China's Banking and Insurance Regulatory Commission said he's very worried about bubbles in both markets, overseas and at home.
The key problem of this sector is the bubbles of this sector, which, as I said, the biggest gray rhino. A lot of people want to speculate or make investment through buying homes, which is very dangerous.
Well, joining us now to discuss all of this is Enda Kerner, Chief Asia Economics Correspondent in Hong Kong. Thank you so much, Enda, as always, for joining us.
Okay, ladies and gentlemen, if you follow this trade, if you sold short with me just at the beginning, we're going to place stop on profit. Price I'm looking to stop at 138.77. Let's wait until the price will go lower. It's all about how much broker gives you, permit you to place stop on profit. In our case, we need to, the price is supposed to go below 2-3 pips. So I'll be able to put stop on profit at the price, in this case, 138.77. So I'm waiting until the price will go up to 138.75. So then, only then broker will let me place this price. Otherwise, I will have to put my price at the higher level, maybe on even like 138.79 or 138.80. You know what I mean, yeah? So let's see. Now it's look like it start moving up. So we'll see. We'll see if it will go up. I'll wait. I will play stop on profit a bit later on. Let's see. Let's wait. I'm still waiting for. No, let's wait for another time. Hey guys.
Domestically, we know that China's recovery has been pretty strong, and we know that the central bank is trying to talk about tapering support for the economy, not necessarily tightening per se, but at the same time, this raises questions about will they take further measures in the property market.
Okay, I'm placing a stop on profit, like I said, at 138.77. Right now, I'm able to do that. So whatever happened, I will be in profit. If the direction, momentum of the chart pattern, whatever happened with this pair will change, and if it will go up, I will be in profit. Okay? Nice trade, guys.
Of the British Fashion Council, Stephanie Fair. Up next, though, we speak to one of the world's most influential economists, the director of the London School of Economics and former deputy governor of the Bank of England, Manoush Shafiq. Now, please send us all of your questions for Manoush and Stephanie using the IB. You can just go IB Plus TV. We'll talk to Manoush next about her new book. This is Bloomberg.
I'm going to move further my stop on profit to 138.74. Okay. So anybody who wants to get strategy we use, you can get it from our company website, company.co.uk. You can get it from, we're going to have tomorrow webinar. If you can see, we on Ticker, we publish the website where you can register for our webinar. We give strategy, and you can discover how we trade, how we use the strategy. So you're welcome to register.
There's a very good chance you're going to have a gangbuster economy for the rest of this year and, easily into 2022. And the question is, does that overheat everything? And we just don't know yet. But I would put that on the things to worry about. I wouldn't worry too much about it. I would worry more about COVID and nuclear war than I'd worry about that. But I would suspect there's a pretty good chance you're going to see rates going up and, people starting to worry about that at one point. I've been very clear. I would not buy 10-year treasuries, just so you know.
Well, that was, of course, the JP Morgan Chairman and Chief Executive Jamie Dimon speaking in exclusive conversation with Bloomberg's Ed Hammond. Now, you can catch more of that conversation throughout the day. Now, Minouche Shafik is one of the world's leading economists. During her career, she has worked in senior positions at the World Bank, the Department for International Development, and the IMF before becoming Deputy Governor of the Bank of England in 2014. She now serves as the director at the London School of Economics, and her new book, What We Owe Each Other, is a new social contract, actually comes out this week. In the book, Minouche sets out the basis for a new social contract fit for the 21st century. Now, she draws on evidence from across the globe to identify the key principles every society must adopt if it's to meet the challenge of the coming century. Well, Minouche joins us now. First of all, Minouche, congratulations on a wonderful book. It's 225 pages long, so it's not a heavy lift, and it's just way smart. When you look at the social contract, Minouche Shafik, and the reason why you actually decided to write this book, has it gotten worse because of the pandemic? I know in the book you also specifically talk about the social contract that businesses need to focus on.
Absolutely. I think it's great to be with you, Francine, for starters. I started writing the book after 2016, and when the world seemed so incredibly divided and we had Trump and Brexit and rising populism around the world, culture wars, and that was the original motivation. But of course, the pandemic has revealed the fault lines in our society even more apparently. And it's clear who suffered the most from the pandemic. It's the poor, minorities, women, and people in precarious work. And I think in many ways, the idea of a new social contract has become even more relevant after the pandemic.
Have we always been a me society, but because capitalism has grown, it's much more evident, or has something actually changed in the way we do business and we look at the people around us?
Well, I think the focus on me got more intense in the 80s and 90s. If you think about the social contract with business since the 1980s, government policy has been focused on maximizing efficiency, liberalizing trade, privatization, deregulating labor markets. And firms have responded by cutting costs, reducing benefits, and outsourcing their supply chains. And that has benefited shareholders and customers because we all buy many products now more cheaply because of those efficiency gains. But it has come at significant costs for workers whose incomes have stagnated and they face much greater insecurity in their lives. And I think the combination of the reaction to the financial crisis and COVID mean we have a chance to rethink that social contract with business.
How do you think that social contract should change, and how much of it do you think will change?
Well, so I think in terms of how it should change, I think it means more pressure on companies to pay their fair share of corporate taxes. And I think it means providing all workers with benefits regardless of the kind of contract they have, if they are flexible workers, gig workers, and so on. On corporate taxes, you can see the debate happening in many countries already, that corporate taxes have fallen dramatically over the last 30 years, and I think many countries are now looking to change that. I think it's compounded by the fact that international tax avoidance has gotten so prevalent. Something like 40% of corporate profits around the world are in tax havens. Half of the companies in the UK, for example, half of the subsidiaries of multinationals pay no tax in the UK. I think there's an opening because there's a very clear proposal from the OECD that proposes two pillars. One, that you set a minimum corporate tax rate globally, and so that countries won't compete with each other to try and kind of beggar their neighbor. And second, that you start taxing corporations on where the economic activity occurs rather than where the legal entity is. And the fact that Janet Yellen last week reversed the Trump administration's opposition to this policy means I think we have a real chance of a breakthrough on a more fair international corporate tax system.
Minusha, at some point in the book, I think about 3/4 in, you lay out 4 very important questions, which is actually, how can we retain the benefits of flexibility while reducing risk and insecurity for workers? You also ask, how can we create more high quality jobs, and how do we enable workers to adjust as jobs change? How do we provide income security as well? Out of those 4 questions, I guess the most difficult one is how do you provide high quality jobs, and whose job is it to retrain workers? Is it businesses or government?
Yeah. So I think one of the phenomena of the modern labor market is that workers are less attached to their employers. People turn over jobs more quickly, and that provides less of an incentive for firms to train their workers. I think we can do 2 things about that. One is that just like we give firms tax credits to do research and development, we could give them tax credits to train their workers, so they will train them more than they might otherwise do. I think the second thing is that most countries in the world underinvest terribly in retraining adults. And we know it can work. There's huge evidence from hundreds of studies that over time, reskilling adult workers can work, but you have to provide sufficient resources and you have to take a long-term view. Now, that probably has to be financed through public sector funding. But I think if you do that, you can create a labor market where firms don't have to worry about letting workers go. If you look at, say, the Nordic countries, Denmark, Sweden, and so on, Finland, they have very high worker turnover. People get fired all the time, but it's not a problem because they get generous unemployment insurance, very quickly get put into training programs, and very quickly find new jobs. And that kind of labor market, where you retain the benefits of flexibility, but provide workers with security, I think is one that would work, but would require more public funding for reskilling.
Minusha, thank you so much. Minusha Shafiq there of the London School of Economics stays with us, and we'll talk a little bit more about productivity next as well. Up next, we continue our conversation with one of the world's leading economists, the London School of Economics director and former deputy governor at the Bank of England. Minusha Shafiq is back. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, or trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It's too early, I think, to judge by how much taxes will need to go up or spending cut. I think it is, we keep alternating between moments of pessimism and optimism. The right thing to do now is to keep options open and not to commit ourselves to a precise path for government tax and spending measures.
Well, that was the former Bank of England Governor Mervyn King looking ahead to tomorrow's UK's budget on this programme. Now, Rishi Sunak's budget statement in the Commons will be closely watched, not least by the City. The UK Chancellor will reportedly use a budget to launch a post-Brexit fight back to help London compete with New York, Amsterdam and Frankfurt. The Financial Times says that the UK government wants to bring in a new stock market listing regime with a review on dual-class shares, IPOs and SPACs. Well, we're back with Manoush Shafiq, one of the world's most influential economists. Between 2014 and 2017, she was the Deputy Governor of the Bank of England, and since 2017, she's been the Director of the London School of Economics. She also has a book out this week called What We Owe Each Other. And Manoush Shafiq, thank you so much for staying with us. When you look at what you write in the book, the new social contract, and I guess, the ability for the UK to really forge its path now, I guess in part thanks to the pandemic, which means that they can spend more, that they can kind of change, but also in part because of Brexit. How do you see the UK economy behaving in 3-4 years? What needs to change now for it to flourish later?
Well, I think a key thing is around trying to tackle the productivity puzzle that we have all been talking about for so long. I think one of the things I say in the book is that part of the problem is that we don't take advantage of all of the talent in our societies. When you look at the US, for example, you can explain a huge part of the productivity in the US economy over 50 years because jobs which were the purview only of white men for decades were suddenly opened up to women and people from ethnic minorities. And that can explain 20 to 40% of the productivity gains in the US. And so policies of tapping into the talent, making it easier for women to stay in the workplace, opening up jobs to a wider and more diverse group of people is actually a key part of the productivity challenge. I think another part is around competition. And There's been a lot of debate about competition policy. I think you can see in many, many sectors of the economy, we've actually seen growing concentration. And so I do think it's time for us to rethink competition policy for the digital age.
Yeah. And Minouche, you touch about this in the book. Is basically the only question worth asking, even if you're a politician, even if you're, almost a central banker, is will young people have a better or worse life than their parents? Is that how we should measure success actually in our economies?
Well, that is the central question for the intergenerational social contract. And for the first time in every advanced economy, polling shows that people think their children will have a less good life than their parents. And that's an extraordinary phenomenon. And I think we have to ask ourselves why that is. And there are many reasons. One is that young people today have to often pay for their education, they have higher debts, their job prospects are poor, and house prices are more, have gone up. And so all the things that previous generations benefited from in terms of higher levels of social spending, lower house prices, buoyant job markets are not there. And the pandemic has only made that worse. And so I think we need to think very hard about this coming generation. There's several things we can do. I've long advocated that we should give young people an endowment to fund their education throughout their adult lives. And that would enable them to reskill and retool for careers that are going to last 40 or 50 years. I think we also have to think what old people should be doing differently. People are going to have to work longer and delay retirement. People now expect to spend about a third of their life in retirement. That's a very recent phenomenon. People used to spend very few years in retirement and were able to contribute through taxation far longer. And I think older people need to think about delaying retirement so that they don't draw on pension schemes too early. So I think our intergenerational social contract is in trouble, but there are things we can do to make it more fair.
Minouche Shafik, thank you so much, and congratulations again on the book. The London School of Economics director, former Bank of England deputy governor, and her new book out, What We Owe Each Other, is out this week. Now, on to banking, carrots and sticks. Jamie Dimon refuses to make vaccines compulsory for JP Morgan employees. Up next, we bring you more of our exclusive interview. We also look at everything that's going on in the markets. Dollars actually gaining a touch. S&P 500 futures pulling back after the index capped the best day since June. European stocks ticking up, commodities sliding a touch. This is Bloomberg.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Not buying treasuries, Jamie Dimon tells Bloomberg exclusively that the U.S. debt is not attractive to him at these levels. Up next, we bring you our exclusive conversation. China's top banking regulator says he's very worried about frothy foreign markets, stocks and futures slip, and making London competitive. The UK Chancellor Rishi Sunak wants listing rules in London to match New York and the continent to attract more IPOs and SPACs to the city. Well, good morning, everyone, and welcome to Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, carrots and sticks. JP Morgan's Jamie Dimon would like his employees to get the COVID-19 vaccine, but he says it's unlikely that the bank will mandate the shots, at least for now. Bloomberg's Ed Hammond spoke with him exclusively.
Getting through COVID is absolutely critical, and we're still in it, though God knows it looks like there's light at the end of the tunnel, by the beginning of the summer or something like that. But it's not a binary subject. I think, Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. Women who had to go home, who basically stopped working because they had to go take care of something like that, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? And we just throwing money at people at one point. And there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it too much.
But isn't the risk exactly that if you have places and states, people that don't need help and getting the help, you overflood the system. Yeah. You do create this huge risk of inflation.
Yeah, and the system already has a little bit of that. So if you look at what's in the system, it looks to us like there's $1 trillion, $1.5 trillion that's unspent. That's before this $1.9 trillion. So there will be money, there's a very good chance you're going to have a gangbuster economy for the rest of this year and, easily into 2022. And the question is, does that overheat everything? And we just don't know yet. But I would put that on the things to worry about. I wouldn't worry too much about it. I would worry more about COVID and nuclear war than I'd worry about that. But I would suspect there's a pretty good chance you're going to see rates going up and, people starting to worry about that at one point.
Let's talk about COVID for a second.
I've been very clear. I would not buy 10-year treasuries, just so you know.
On COVID, we are obviously doing this interview in person, which is fantastic. We're doing it in your offices here in New York, but still largely empty, as are my offices, as probably are a lot of people's offices. How important is it to a business like JP Morgan to actually have people physically coming back to work?
It's very important. I do think there'll be part of the world where a certain amount of people work from home permanently, certain sales, certain ops, so you can track the productivity, et cetera. I think there'll be a large portion who permanently work in the office. Think of our branches, cash management, probably most of the trading floors, et cetera. And there'll be some hybrids where you spend 2 weeks at home and 2 weeks in the office, or 3 weeks at home, a week in the office, or 3 days and 2 days and 2 days, 3 days. But so I think it will reduce the need for commercial real estate, but there are huge weaknesses to the Zoom world. Most of us learned by an apprenticeship system, by seeing mistakes, going to trips, how do you handle a client, how do you handle a problem. So it's hard to inculcate culture and character and all those things when you have the Zoom world. Spontaneous combustion, it goes away. Hard to manage. It's hard to be very critical. You got 15 people on the screen. So what before was like a deep dive question, now looks a little bit rude. And I took a trip to California and met 100 people all outside, all wonderful, breakfast, lunch, and dinner. It's amazing how much you learn about your own business, your own bankers, your own clients, your own products. And, I met with Snowflake and Marqeta. What you learn about technology and systems, you're not going to do that in the Zoom world. And, so bankers, relationships. I think it's very hard to build and develop and deepen a relationship on the Zoom world. So you still, there'll be more Zooming. People like me will travel just as much as I did in the past.
As and when the vaccine does become available for your workforce, will you make it mandatory for people to take it if they do want to return?
It's hard to make it mandatory. And there are laws about that. But I think what we'd like to do is kind of have carrots and sticks. We want people to take it. I think it's a far better thing. You certainly can't make it mandatory before it's fully accessible, so that question can't even be answered until June. But I do think you may see some companies do it. I mean, I can see an airline doing it or a hotel company doing it. I can see some people saying if the folks in our branches aren't vaccinated, they're not going in. So there will be pressure, and I would say carrots and sticks, not mandatory.
Well, that was, of course, the J.P. Morgan chairman and chief executive Jamie Dimon speaking in an exclusive conversation with Bloomberg's Ed Hammond. Now, you can catch more of that interview throughout the day. Now, as we just heard, Jamie Dimon has been one of the most vocal supporters for a broader return to the office. He said his firm has seen alienation amongst younger workers and that an extended stretch of working from home could bring long-term economic and social damage. Well, joining us for more on this is Bloomberg's finance editor, Marion Dakers. Marion, great to have you on the program today. What's the general feeling amongst top banking executives about when their staff need to return to work?
Well, I think in London, currently it's obviously driven by the levels of virus. We're still in a national lockdown, so nobody's going anywhere in the short term. In the long term, for example, Lloyds have done a survey of their staff, and something like 3 in 4 want to work from home, most of the time. So as lovely as Jamie Dimon's idea of breakfast, lunch and dinner meeting people sounds for the very senior level, I think most people are expecting some sort of hybrid solution rather than everybody piling back into the office as soon as they can.
Marion, when you look at the Goldman Sachs chief executive, though, he basically said it's just not working having people work from home. It's unnatural. Will we see the big Wall Street banks demanding employees go back to work, and companies that maybe are seen as less aggressive, maybe some of the European banks, even the UK banks, work differently?
I mean, he's right that it's been an aberration, but the whole previous year has been extremely unusual. People have become teachers and community support workers as well as investment bankers, and some of that will fall away in the coming months, and then we'll get a clearer picture of exactly what people can do from home in a more normal setting. I mean, I think HSBC, who have a big investment banking presence, they are also looking at some sort of hybrid model, so acknowledging that some of the work can be done from dining room tables, as I'm doing now. Rather than requiring even the investment banking staff to get back into the office and travel.
Marion, what about this morning's report that Rishi Sunak wants to make the city more competitive around listings?
Yes, I think that'll be welcome news for people in the City of London, having been largely left out of the Brexit trade deal and economic discussions over the past couple of months. If he can reveal something in the budget that will remove some of these hurdles that might keep firms from listing in London, particularly these tech firms that are held up as a growth industry for post-Brexit Britain, will be extremely interesting in the budget tomorrow.
Yeah, it should. Thanks so much, Marion Daker, there, a finance editor for Bloomberg. Now, parading down the virtual catwalk, up next, we speak to the chair of the British Fashion Council on the impact COVID and Brexit have had on the industry. This is Bloomberg.
Nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
What kind of leader are you?
I'm a leader that works on figuring out destinations that we should aim for and then chooses the direction.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get a view on the markets with our Danny Berger, who's been looking at the morning's biggest stock moves. And Danny, it's all about China, and of course, Treasury's always simmering in the background.
Yeah, it absolutely is. And I think that's part of the reason we're getting so much divergence in today's market, because it's one that is shaky, it's vulnerable, and should there be another, should we say, spike in Treasury yields or anything like that, it's one that could really set the market off. But that's also giving today some breathing room for the individual stock stories to actually have a difference on the price of equities, rather than everything dominated by the macro. Taylor Wimpey, for example, reporting earnings today that beat expectations. Its outlook beat expectations in terms of its margin, and also reinstating its dividend. It's this UK housing story that's been really strong, with the government set to continue to support mortgages. Now, some of the biggest movers to the downside: Boohoo Group might face a U.S. import ban over concerns of practicing modern-day slave labor. The U.S. says, and this is according to Sky News, and the U.S. authorities say that they have enough evidence to move forward with this. Boohoo telling Sky that if they had known about anything, if they'd seen anything like this, they certainly would have let authorities know. Finally, HelloFresh also moving to the downside, reporting very strong earnings, but it's the outlook that is concerning as well. And Francine, I also just want to say quickly, pre-market, Zoom moving much higher, earnings very strong for them. They had moved up 10% in aftermarkets trading, pre-market 8% as well. They're forecasting an earnings growth of about 43%, beating the average analyst estimate of 37%. Francine, even as the world normalizes, I guess we're still all going to be on Zoom.
I know, Zoom. I mean, I can't tell if it's my best friend or my nemesis. This is like, the only question worth asking in 2021. Danny Berger, thank you so much with all of the main movers. Now let's get straight to the Bloomberg Business Flash.
Okay, guys, good trade. As you can see, we sold at 138.74 British pound. Let me, I'll show you where. Just right here. Position closed. It took us what? Hour and a half to complete this trade. Well done, all of you who follow this trade. You made already a good profit. If you use our strategy, you know what we did. If you don't, you can get the strategy from our website, or you can register for ticker. For webinar. You can find it on ticker red color. Yeah, it's called in 90s called ticker. We used to watch prices on New York Stock Exchange. So right now it's not really popular, but before it was quite popular app, you can call it, that prices you could open kind of new information, and you can add this information to your computer on the screen, and every time you could see ticker price for Vodafone, for example, or other companies. They would appear on your screen, and you wouldn't have to go to other websites. So the webinar you can see on the ticker, red colored. So if you're interested, you can register. Otherwise, you can get a strategy and you could trade other pairs. In our case, we will not show you any other pairs because we trade live money. This is not demo accounts or something. If you are interested more in schools or academies, it's better for you to use other sites, other academies, because we trade other people's money and you can follow our trades. It's free. Okay, good trade, guys. I'll speak to you later.
It's been ongoing. And I think to answer your question, it's a combination of all of that. Brexit has been an ongoing conversation for at least the last 3 years, highlighting the specific needs of the fashion industry and how difficult it was predicted it would be. And some of that has come true. You then add COVID on top of that, and it's been very difficult for the industry.
So what's the one thing that the industry in the UK now needs from government? I know we have the budget tomorrow. Has government done enough to support the British fashion industry, which frankly has been, alive and kicking up until the pandemic?
Yes, so for the size of the fashion industry, which contributes 35 billion to the UK economy, and given the issues around COVID and Brexit, it's expected to drop by about 10 billion. It really is an important industry and needs to be looked at on a par with manufacturing, fishing, cars. We are in constant contact with government, with our government agencies, and there is conversation, but we are calling for more from government, and it is urgent. There's some short-term needs, which happened during COVID. So grants, access to loans, those are sometimes very difficult for the fashion industry to access because of the specificities of that. Medium and longer term, there are three main areas. There's talent and movement of talent, trade and IP. I think of those, the most urgent is movement of talent. We would like immediately for the government to look at exemptions on travel for creatives, models, fashion photographers. This is big business in the UK, and it is very quickly moving to Europe. On the topic of trade, very important. We're seeing, because of the red tape and bureaucracy around the import and export. If you think about the fashion industry, it's a complex supply chain that requires a lot of movement of years. Creativity happens here, manufacturing happens elsewhere, and the VAT regimes of the 27 countries really is coupled of Europe, coupled with the red tape required around country of origin. It's really crippling for the industry, and we need government support not only to facilitate that, but longer term come to a better agreement. And then, of course, longer term other issues such as IP, which is so important given the creativity of the British fashion industry.
Stephanie, on a more immediate point, I guess, we don't dress up as much as we used to because we don't go out to parties anymore. We don't go out to bars or clubs or restaurants. Has it changed what some of your designers are saying they need to produce? Or do you have an estimate at overall how much sales have dropped? Are people shopping far less in the fashion world because they're staying at home?
It's a story of two halves. Demand has absolutely dropped, and we saw that at the beginning of the COVID pandemic when no one really knew what was happening. But that has actually gradually picked up. There is certainly a change in category mix, as you might expect. People aren't going out as much, so there's much more of a focus on leisure wear, active wear, lounge wear, casual. But people are starting to want to invest, and there's a focus on investment pieces. If you look at some of the top luxury brands, they've actually performed very well in this space. People are looking for quality. They're looking for sustainability. They're thinking about different ways of shopping. So it is a tale of two halves. I think retail and bricks and mortar has absolutely been affected, as you might expect. Stores are closed. Online in parts has boomed. So it isn't to be painted all with one brush, but we need to make sure that we think about what the future could look like, how we can build back better, and we need government support and engagement to do that, along with government policy, which is to build back better, to level up in the regions, and to think about a more sustainable industry that can really champion the value of the UK.
Stephanie, has Brexit proven to be, worse than expected in terms of taxes and shipping things and getting models over, or has it actually been better handled than expected?
I think, again, the answer is a mix. The good news is that we had asked our designers to prepare for a tariff environment. The good news is that those tariffs did not happen, that 12%. However, we did not get the tariffs, but we got a huge amount of red tape and paperwork, as I was mentioning before, which adds 12 to 15% to the price of goods and makes them wholly uncompetitive. That comes from having to really fill out extensive customs reports. That could be viewed as midterm pain, but actually there's some fundamentals there that are not suited to the fashion industry. So on balance, it's not been a good outcome for the fashion industry. And designers are having to make decisions. They're offshoring their manufacturing. They're thinking about other ways to look at their supply chain. And we don't want to lose that. We work closely with UK FT. We want to maintain the value of manufacturing up north in the regions. And this is very important, but not if there's not a much longer term solution for the import-export environment.
Stephanie, thank you so much. Stephanie Fair there, the British Fashion Council Chair and Farfetch Chief Customer Officer. Now, coming up, did the Johnson & Johnson vaccine add to your vaccine confusion? Well, up next, we break it down with Sam Fazeli from Bloomberg Intelligence. He'll answer the latest questions about COVID vaccines and the variants, of course. This is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse. Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP. But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Yearly Edition. I'm Francine Lacqua here in London. Now, this week's Bloomberg Opinion highlight is Sam Fazeli's Q&A. Now, in his piece, he aims to answer all of the questions that we need to know after the FDA approved Johnson & Johnson's vaccine. It's called Did Johnson & Johnson Add to Your Vaccine Confusion? Well, you can read it on OPIN Go on the Bloomberg terminal, or you can also find it on our website. Joining us now for more is Sam Fazeli, Senior Pharmaceutical Analyst for Bloomberg Intelligence. First of all, Sam, a very well thought out and well-written piece, but I want to ask you about the variants, because I understand there are 5 variants across the world that we should worry about or that health officials are actually monitoring. When do we know whether these variants are dangerous?
Hi, Francine. Excellent question. I think the thing we already know that some of the variants, I think the ones that have probably got good enough evidence for us to say that are more transmissible. They're the ones which are B117 from the UK and B1351 from South Africa. So we know that already. Are they more dangerous in terms of causing worse disease? Well, of course, if you can catch it easier, then you're more likely to have more people infected and therefore higher rates of hospitalizations and deaths, if that were to be the case and there are no lockdowns. So that's that. But whether they specifically themselves are going to be more pathogenic, I don't think any of that data is available yet.
Sam, going back to, if we have too many vaccines, is it confusing? Is there a danger that people will start refusing the J&J vaccine because it's one shot only and would prefer another one? How worrying is it if people start choosing what vaccine they want?
Yeah, so if I were in anybody else's shoes and I walk into a doctor's office and they say to me, here's your vaccine, I wouldn't question what it is, because they all have very high levels of efficacy against hospitalizations, severe critical disease, and of course, by inference, death. If we were in a world where we have, which is one of the things I've said in another piece, Francine, where we have an option to choose, and we are at the luxury of being able to do that, and the world's moved on from trying to manage this health impact of the pandemic and the economic impact of the pandemic, then I would personally like to choose one of the mRNA vaccines based on what I know today. It's very early days still. So there's two issues to think about here. What do I do right now in the middle of this pandemic? Take any vaccine I'm given. What do I do in a year, 2, 3 years' time if I need a booster and I have the option to choose one? I would go for the mRNA vaccines based on what we know today.
Sam, thank you so much. As always, Sam Fazeli, their senior pharmaceutical analyst for Bloomberg Intelligence. Well, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kayleigh Lyons is in New York. We'll, of course, look at the markets. We also have a great conversation speaking with Mathieu Chabran of Tikehau. We'll talk to him about private equity and SPACs. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean?
combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
There are a lot of people suffering who need help. Get us through the problem, get the country growing, but don't try not to overdo it.
K-shaped recovery is not acceptable. That's the bottom line.
Survival is not the end game. We want our cities and our countries to thrive, not just survive.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Is there a mic problem? Possibly a microphone problem. I keep thinking, is there a microphone problem? I never know if it's just me, a microphone problem. Francine, maybe the battery pack is dead. I don't know. I'm not a technical person, but welcome to the program. Thanks very much for joining us. There is so much going on in these markets, Kaylee, and after the incredible rally that we saw yesterday, it's going to be interesting to see how today opens up. Obviously, people are going to want to take some profits off the table, but why don't you, while we get Francine's microphone issues in order, walk us through what you're seeing in markets?
Well, I'm seeing a lot of red on my screen, Matt, and in part that has to do with the conversation out of China overnight, the top banking regulator raising concerns about asset bubbles in certain markets. That took Chinese stocks, the CSI 300, down about 1.3% in the Asian session. And while over in Europe, stocks are holding on to marginal gains, we are seeing futures pointing to a lower open here in the U.S. NASDAQ 100 futures down by about 0.5%. Of course, that index holds a lot of the richly valued big tech names, and they may be hurting too, given we are seeing yields inching higher once again, up about 2 basis points on the 10-year note today. I would note that one area of the market where a lot of people do raise bubble concerns is in Bitcoin, but it too is holding in the green around $49,000, probably helped by the fact that institutions like Citi and Goldman Sachs seem to be warming up to the cryptocurrency. But in other areas, in individual equities where valuation and froth have been raised and called into question, we are seeing them under the most pressure in pre-market trading. Some of the worst performing stocks early on are the likes of GameStop, which is lower by 4%. Churchill Capital, Fuel Cell Energy, which is up 800% on the year, is down 2.5% in the pre-market. And Tesla, the poster child for a richly valued company, is also under pressure this morning, Matt.
Yeah, I think, you say people raise bubble concerns about Bitcoin, and I wanted to say they have been for 10 years, but they've been doing the same with Tesla for 10 years as well. I have a great chart today showing the extreme negative correlations we've seen between the 10-year yield and the S&P 500. You've obviously noticed it. You've been paying attention to markets for the past couple of weeks, but not only is this the most extreme, this negative correlation has been since 2016, which means that, if we see 10-year yields jump, we see stocks crash, and vice versa. When yields don't do much, stocks jump on their own. I also love that this chart is called Danger Zone because I love Top Gun. I'm a huge fan. I can't wait for Top Gun 2, but I also love Archer. So just saying dangers, and Kenny Loggins as well. So this is a great chart. It's 4261. If you're sitting at home or in your office checking this out, pull it up on your Bloomberg, use it in your notes, and you don't even have to credit me. Fran, are you back? No, Fran is not back. Okay, we have issues there with Fran's microphone that maybe we're going to be able to fix during the break. I hope. Maybe it's a problem with the City of London. I hope that's not the case. But of course, no one knows what happens in the City of London post-Brexit. Now, sentiment took a further hit after the chairman of China's Banking and Insurance Regulatory Commission said he is very worried about bubbles in both markets overseas and at home.
The key problem of this sector is the bubbles of this sector, which, as I said, the biggest gray rhino. A lot of people want to speculate or make investment through buying homes, which is very dangerous.
Joining us now from Hong Kong is Enda Curran, Bloomberg's Chief Asia Economics Correspondent. And this is, I think, a much more powerful message coming from China. When you're talking about a government with so much centralized control, it means a lot more even than if this had come from a U.S. official at the Fed or at Treasury.
I think you're right, Matt. I mean, it is a very direct and a very blunt warning from the top banking regulator in China. It's kind of a dual warning, really. On the one hand, he's saying there's clearly signs of a bubble in US and European markets that he's worried about, but he's also warning about the domestic housing market there. And of course, China has been taking steps to rein in house prices through tackling the shadow banking sector and rolling out other kind of curbs on risky lending and the like. But it all adds to this idea now that officials are slowly getting worried around the world about bubbles and frothy markets everywhere. Now, of course, the challenge for China is that obviously, on the one hand, if they want to talk about tightening the housing market, they have to be careful not to trip up the broader economic recovery. But on the other hand, China has an issue at the moment with record inflows, and they're talking about allowing people to move their money out of the country more easily and let them invest in securities overseas. And you'd have to wonder, if the regulator is warning about bubbles in overseas markets, how they will then allow their own residents to invest overseas without getting caught up in those kind of bubbles. So it's something of a tight balancing act for the Chinese regulator.
Right. So how could this disrupt the fact that China is trying to open up its economy further to foreign investors, to other capital markets?
Well, it's an interesting question, because at the moment they are enjoying very strong, if not record, inflows into their bond and stock market, as you mentioned, because they have been opening up gradually. But because those inflows are so strong, and because there's some pressure, upward pressure on the yuan, they are now talking about releasing some of the pressure on terms of capital controls and allowing their own people to move money out of China. At the moment, there are very strict rules on what you can move out of China. It's a limit, I think, of around 50,000 US per person. But now they're saying we might allow or lift some of that limit to allow people to invest in these overseas markets. And of course, that begs the question how they can go about doing that and allowing their own savers to move money overseas, if on the other hand the regulator is talking about or warning about bubbles in overseas markets. So it's going to be something of a balancing act to see how they do frame this issue. Now, the regulator did say that he's not overly concerned about the pace of inflows into China just yet, that they are manageable. But clearly this is something on their radar and worth keeping an eye on over the coming months.
Yeah, absolutely. But bringing more people into markets, bringing more people into business has been a huge part of China, getting millions, hundreds of millions of people out of poverty and into the middle class. Give us the 35,000-foot view of how that has been happening in China over the past decade. How have they managed to kind of move, entire masses of people into a different wealth class?
Well, there's no doubt it's night and day in terms of China's financial markets today compared to what we've seen over previous decades. If you take the last decade alone, we've seen much more opening of their financial markets. Foreign investors now flow into their bond market in a way unimaginable only a decade ago. A lot of that happens through Hong Kong. A lot of it is still controlled, but it's certainly come a long way compared to where we were a decade ago. The push for the yuan to be used more globally, of course, hasn't really taken off, but it's still made strides compared to where we were a decade ago. It's more of a managed float now, more freely tradable than it was. And of course, we know that China's own stock markets continue to boom because they have plenty of their own homegrown giants now. Look at what's happening in the technology sector with the national champions there around Huawei and Tencent and JD and everything else. And we see that happening in Shanghai, and we see those companies coming to Hong Kong. So in terms of its deepening capital markets, in terms of its broadening domestic investor base, and in terms of opening up to allow foreign investors pour in, I mean, investors tell me every other day of the week that they're chasing Chinese government bonds because they want the yields on offer. So there's no doubt that China's financial markets have come a long way, and that growth potential is still there, by the way, as evidenced by the inflows, and as evidenced by the fact that the regulators are borderline getting worried now that they're attracting too much money, hence they're talking about allowing money to leave more easily. So it's night and day, Matt, compared to what it was even a decade ago.
All right, we have to leave it there. Thank you so much to Bloomberg's Enda Curran in Hong Kong. And joining us now is Nicola Mai, PIMCO Portfolio Manager and Sovereign Credit Analyst. Nicola, if China were to tighten conditions further, what ripple effects would that have?
I think that, yeah, the Chinese, sharper deleveraging in China, so stronger regulatory pressures, a less supportive PBOC are definitely a risk for the outlook. If you look at actually the global manufacturing cycle and a measure of the Chinese credit impulse, which is the sort of change in credit growth in China, you can see a pretty tight correlation there. And we are expecting a slowdown in credit growth in China. That's part of our baseline outlook. But obviously a sharper one would be negative for macro and therefore for our markets.
So do you take a look, Nicola, at your portfolio then in light of this news and, you know, make some hard decisions here?
I think as I said, I think some tightening in China's credit markets was expected. So I wouldn't overplay this comment. I think, you know, China is likely to keep rates stable, but on the regulatory front, it's worry about bubbles, about excess leverage. I mean, those have been part of the outlook. So at this point, I wouldn't necessarily change the baseline based on that. But obviously, we'll be watching this closely as China is a risk factor, an important risk factor for the global economy.
I wonder when you look around the world, Nicola, I mean, how important is China now for your portfolio, for markets, compared to, say, just 5 years ago?
I would say that it's more and more important. So we've done some analysis of global business cycles and who leads and who lags, for example. And what we've seen is that over the past decade, you know, these betas have changed. So the U.S. used to very much lead the global cycle. Right now, actually, China appears to have a leading edge on the global economy versus even the U.S. So when we look at our portfolios, we definitely have a look at what's happening in China. And of course, there's a concern about excess regulatory pressures, but I would say that so far, China has been doing very well from a global perspective, partly because it produces medical goods and technological goods, which have been benefiting from the crisis. And we expect that to be, you know, still a support this year, even though perhaps a bit less than last year. But China is definitely something we look at and also something that we invest in. So in terms of duration, we have exposure in Chinese duration, for example.
Nicola, I want to shift the conversation to the other largest economy you were talking about, the U.S. Obviously, growth and inflation expectations here have been picking up, and that is reflected in the rout we have seen in the bond market. Do you think that has been overdone? And do you think the messaging from the Fed surrounding that has been strong enough?
Look, well, the way we would see it is that the repricing in interest rates so far has been pretty healthy, and that it's come on the back of better macro expectations and higher inflationary pressures, expected inflationary pressures, which is something that central banks, you know, have wanted. So I would say the move up in rates so far has been, as I said, relatively healthy. And I think if you look at the central bank commentary, I think they generally agree with that. So obviously the Fed's assessment and the ECB's assessment is that we're still in an early phase of the cycle. We have to be cautious. But they haven't really significantly pushed back against the increasing rates so far. Now, obviously, the more this move is sustained, the more it would be problematic. So, for example, if you look at the overnight market in the U.S., you can now see, you know, 15, 20 basis points of hikes priced for the Fed by the end of 2022. That's starting to look a bit aggressive. So what I would say is that obviously the higher the moving rates from here, the more we should expect some kind of reaction by the central banks.
I actually have a chart here, Nicola, showing the overnight repo rate. And, well, if we pull up the chart, we can see it's 43.19. Highly recommend checking this one out. On the top of the screen, you see the 30-year bond. And, of course, these jaws are widening. You know, the curve obviously is getting steeper and steeper. There's so much more talk now about the Fed coming out and doing something like yield curve control again. Is that what you expect? And if so, when, Nicola?
I don't think we're here yet. We don't expect the central bank. Currently Treasury yields are 1.4 or so in the 10-year. We mentioned a low range for the Treasury yield going forward, the so-called new neutral rate, and we're kind of in that range right now. So interest rates will be lower than they used to be because of technology, globalization, inequality, and so on, lowering the equilibrium level of rates. And also we expect inflation to remain moderate, partly because of automation and low bargaining power of labor. So we see a modest rise in inflation, but not a steep one. And I would say that the current level of rates is broadly consistent with that sort of equilibrium. Obviously, as I said, the more we rise from here, the more the Fed would respond. I think that the Fed initially would use mostly verbal intervention. If needed, they may adjust the purchases, but that's not what we expect right now. So we think the Fed is still not in a place where it's keen to intervene. It would probably need a further increase in rates from here.
Well, of course, we still have a lot of Fed speak on deck for the remainder of the week, so we will all be paying close attention to anything they have to say. Thank you so much to PIMCO's Nicola Mai for joining us. And coming up, Jamie Dimon says the pandemic may permanently shift where work is done. More from our exclusive interview with the JP Morgan CEO. And coming up later this hour, Mathieu Chabran, Tikehau Capital co-founder. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
To a Bloomberg exclusive, and JP Morgan boss Jamie Dimon has made the case for a broader return to the office, saying an extended stretch of working from home could bring long-term economic and social damage. Well, Dimon discussed competition, growth, and more in an exclusive interview with Bloomberg's Ed Hammond.
JP Morgan itself is doing great. So all of our people, look at it, we're doing quite fine. But you have fintech, big tech. You saw Walmart recently. So we just have to be prepared for intensified competition. We're ready for it. We're very competitive, and we expect to win.
But the growth of some of these fintech companies, if I look at Adyen or Stripe, for example, it's been so exponential.
And then I look at what some of your competitors have done, Morgan Stanley notably with the E-Trade deal. Do you not think there would be a case to be made that JP Morgan should go out and just buy one of these giant fintech companies, plug it in, and then you're good to go?
Yeah. So you should assume we look at everything. And like I said, some of the things we do ourselves, we've done quite well in these areas too. But you're absolutely correct. Some of these people have done a great job. And sometimes it's not cheaper. It's not even better. It's usually just ease of use or something like that. But I assume they're coming. I've dealt with competition my whole life, and we're open-minded to acquisitions. We're open-minded to building ourselves. But what we tell the people here in this very room, in fact, is we should do what we need to do to win in technology, people, systems, marketing, analytics, AI. And obviously, we're doing an awful lot of AI and cloud work and things like that.
Another thing fintech has done, or at least is partly responsible for, is this sort of democratization of investing. Obviously, the rise of the retail trader, the Reddit crowd, Roaring Kitty, whatever you want to call it, is creating this narrative at the moment of David v. Goliath. Now, as a very prominent Goliath, do the Davids have a point? Is the system rigged?
God,
or stacked against them, at least.
In every bull market, this has happened in my life. So this is not a new phenomenon. And I do believe that people should learn how to invest their money, but they should do the homework. I mean, thinking you go on and just gamble and play, that doesn't have a long-term success record. And so, but to the extent that people are learning and they're getting involved, so that's a good thing.
Well, one bit of the industry that obviously has been savaged to some extent recently is the short-selling hedge funds. Do you think that industry is in crisis because of this effect we're seeing, or this phenomena of the retail trader?
Absolutely not. The retail trading in dollars is a teeny, what you're talking about is a teeny weeny little bit of the market. The market is global. I mean, something like $10 trillion is bought and sold every single day. And when we say investors, you're talking about retail investors, pension plans. There are legitimate complaints about short selling, more around transparency and the duplication of vote of the ability to short sell the stock. There are legitimate issues around all these things. That, if the regulator is going to be looking at payment for order flow, high frequency trading, disclosure about ownership, voting, short selling, those are good things. And, to me,
should people be able to pay for order flow?
I think payment for order flow is a very complex subject. I think there should be but there should be much stricter rules about what you mean by that. It's not clear to me that everyone does the same payment for order flow. So if I'm paying a lot more to someone else or keeping a lot more for myself, you probably have the right to know. And there's certain disclosures, they're not very good.
Moving on to the biggest question in finance right now, which is the stimulus enough? Is it too much? Even the interventionists can't seem to agree on this point. You have Larry Summers on the one side saying enough already. You have Janet Yellen, Jay Powell, and others on the other saying more is needed. What do you think?
So getting through COVID is absolutely critical. And we're still in it, though God knows it looks like there's light at the end of the tunnel, by the beginning of the summer or something like that. And it's not a binary subject. I think, Democrats and Republicans are like ships passing the night. There are legitimate complaints about stuff in this bill that has nothing to do with COVID. There are a lot of people suffering who need help. Both are true. So if you want to go through, you go through all the detail. Unemployed, they definitely need help. Small businesses, they definitely need help. People at the lower end, they definitely need help. Women who had to go home, who basically stopped working because they had to go take care of something like that, they definitely need help. I don't know if you know this, but like half the states, revenues went up. They didn't go down. Do they need help? And we just throwing money at people at one point. And there will be another side to that mountain. So they should be cautious about overdoing it. Get us through the problem, get the country growing, but don't try not to overdo it.
Well, that was JP Morgan's Chase Chairman and Chief Executive Jamie Dimon with Bloomberg's Ed Hammond. Now, coming up a little bit later today, a conversation about taxes and the wealthy with Senator Elizabeth Warren, a Democrat from Massachusetts. Of course, her proposed wealth tax on households worth more than $50 million could help pay for investments in infrastructure, childcare, and health reforms. That interview coming up later today. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, the early edition, and here are some of our top stories. Bubble alert, stocks slip along with U.S. futures after China's top banking regulator says he's, quote, very worried about frothy foreign markets. Not buying treasuries, well, Jamie Dimon tells Bloomberg exclusively that U.S. debt is not attractive to him at this level. The J.P. Morgan chief executive is keen to get staff back to the office. And making London competitive, the UK Chancellor Rishi Sunak wants listing rules in London to match New York and the continent to attract more IPOs and SPACs to the city. Well, good morning, everyone, from London, Berlin, and New York on this Tuesday, March the 2nd. I'm Francine Lacqua with Matt Miller and Kaylee Lyons. Matt, a lot going on in the markets because of this banking regulator in China, basically saying he's worried about bubbles in global financial markets, but he did also point to, I guess, imbalances in, for example, the Chinese economy, including what we're seeing with real estate, and that has led markets to believe we could see tightening in the world's second largest economy.
Yeah, that's very important because obviously with such a central government, they really make moves after they make decisions. I'm also watching very closely, Francine, what's going on here in Europe in terms of stimulus. Italy is looking for extra stimulus as the virus outlook worsens there, and this has been a headline I've been waiting for a long time. You see trillions of dollars in stimulus in the U.S. and trillions more still expected. Of course, Europe has these traditional safety nets that work fairly well, but the stimulus we've seen for the entire block has only been 750 billion euros. So you gotta think that investors want to see more before they're ready to buy up European shares.
Yeah, I know on Italy, a lot of investors actually want to see structural reform. And if you look at the structural reform, it will lead to pain. So you need that stimulus to kind of take off the edge. But a stimulus alone will probably not be enough. Now let's take a look at the SPAC mania sweeping the investment world with Kaylee Lyons. Kaylee, what do you have?
Well, Francine, if we thought 2020 was the year of the SPAC, that has only accelerated in 2021. It is true that last year was a record year in terms of blank check companies raising money through IPOs. More than 200 of them raised more than $80 billion. But in 2021 so far, they've raised more than $50 billion, and it is only March 2nd. Now, interestingly, Bain & Company put out a report yesterday that actually found SPACs that had completed mergers from 2016 through 2020 actually underperformed the S&P 500. They viewed 121 transactions, and 60% of them underperformed the benchmark. But that certainly has not been the case in more recent history. Over the last 7 months or so, the IPOC SPAC index has rallied about 70%. That beats both the Renaissance IPO ETF, which tracks newly public companies more broadly, and the S&P 500, which is only up about 20%. Of course, this SPAC index, Francine, includes all of the SPACs, not just ones that have made acquisitions. And we know some of the high flyers like Churchill Capital that rallied after they went public actually fell substantially when they announced they were buying Lucid Motors, Francine.
Yeah, thank you so much, Kaylee. Now let's look at SPACs. Let's look at private equity with Mathieu Chabran. He's a Tikehau Capital co-founder. And Mathieu, first of all, congratulations. I know your asset under management went up quite significantly to about 28.5 billion euros, despite the hard economic environment. Mathieu, overall, why do we need SPACs? There's so much capital to deploy. Is that why there's a love and maybe need even for SPACs?
Well, good morning, Francine. Thanks for having us. I really think that SPAC is just, another alternative to provide, equity that is well needed. Coming back to your comment about, stimulus and debt, European companies need, access to equity, and that, be by way of, private equity, by way of direct listing, or by way of SPAC. So effectively, there's a lot of, comment and a lot of question marks around SPAC, but I would not go beyond effectively this being a new technology that can provide long-term permanent capital to European SMEs that effectively need that badly.
But is this a new asset class? So will Tikehau one day actually have a portfolio just like other asset classes, including private equity and real assets?
I think actually we may, yeah, effectively, because, as you said, it's just about making sure that we can give access to some investors to effectively new investment by using this technology. So the same way, an asset manager can manage private equity fund, can manage mutual funds, can manage REITs, and so on and so forth, CLOs. I mean, here you've got SPACs, and effectively, as far as Tikehau is concerned, since we made, our first announcement a couple of weeks ago, we may very well be, in the first phase of what could be a family of SPACs, in very specific industries. There is no shortage of capital. I mean, there is shortage of leadership. So really for us, it's about finding the right team, the right CEOs, the right operating partners, and effectively targeting the right companies to deploy this capital.
I was going to ask you, what makes a good SPAC, and you've kind of laid it out, but are there enough targets for these SPACs?
Well, there's no shortage of entrepreneurs. And if you look at the past, 10 years and, the very accommodating policies that we've been enjoying, since the GFC have led to many companies, many entrepreneurs, many ideas, in a very changing environment. And so it's about, taking those companies to the next phase of their development. Very often capital market, is part of that. And so, when people talk about the bubble, there is a bubble in the amount of capital that may have been raised, for example, here in the US. But, when you look at Europe and you look at the number of SPACs, it's just effectively some capital that has been raised and is, waiting to be deployed. And if you got the right target, the right management, the right sponsors, you should have a recipe for an interesting growth story on the public capital market.
But I think it's a great question, Mathieu, because I've been going to the Super Return Conference here in Berlin every year for the past 5 years. And, consistently, one of the big topics is there's $1.7 trillion out there looking for a home. There's $2.1 trillion out there looking for targets. There's so much capital chasing such a finite amount of businesses. How difficult is that?
Yeah, but then the next question, Matt, is, how much of this capital raised is looking to buy companies? Because remember that this private capital, tend to be encapsulated in some private equity funds that are looking for the control of the target they're buying. SPAC is an alternative to that because it's not looking for control. It's looking at providing a solution for a private company to get effectively liquidity on the public equity markets with no objective, to take control. So in that respect, for me, it's very complementary, and it's by no means, effectively hunting the same targets. All these private equity funds that you're referring to that, attend the Super Return in Berlin, for most of them, they're doing control investment, they're doing LBOs, they're doing buyout, when effectively SPAC is a growth equity, an expansion capital alternative to this private capital pool.
Can I ask you just a plumbing question, Mathieu, kind of a back office question? When you amass a certain amount of cash and you need to hold that, dry powder for when you find a target, how difficult is it in this punishing rates environment to find a place to store it?
Well, I think, that's a good point. And without being too technical, that's interesting, why the European market probably has not developed as quickly as the US market, because effectively you had this negative interest rates environment that could be somehow, punishing for the SPAC structure. We could elaborate on that, but it's a technical point that is worthwhile, considering. Now, to your question as to, can you be patient and selective when effectively some may think that you've got an incentive to push you to deploy this capital fast? The only answer to that, and the only firewall to that, Matt, is as always alignment of interest. Because if you, as the manager, has sufficient skin in the game in the project, then you're going to be selective. You're not going to be effectively chasing and going for the very cheap option that the SPAC can sometimes be criticized for. But if you put your own capital at risk side by side with the investors, like any managers should do, and which at Tikehau is exactly what we've been doing for the past 15 years, then normally you're much more disciplined in the way you deploy this capital.
Mathieu, when you look at private equity at the moment, where do you see the biggest risk?
Well, risk is certainly, coming back to the control investment I was referring to, and the valuation you may see from time to time. A lot of people are saying, post-COVID, let's say over the past 12 months, it's about the dispersion between, the good assets and the average assets. And the good assets trade for crazy multiple with effectively the support of very high debt multiple. And for the average assets, they tend to trade very poorly, if not, trading at all. So it's obviously, on the valuation, because people tend to have, short memories. And as much as, we're all hoping for, a fast recovery as we get out of the COVID and the pandemic, when you see companies being bought, for 20, 25 times, their cash flow, those are as many years you need to effectively pay back your investment. It's no different from the public market. So that's why, control premium on some private equity transaction seems to be a little bit of the hot area right now in terms of valuation, when on the contrary, when you provide expansion capital, growth equity to family-owned companies, entrepreneur-led company, where you're not looking for the premium from the controlled premium, this is where you get a very interesting risk-adjusted return.
Mathieu, thanks so much. Mathieu Chabron there, Tikehau Capital co-founder, stays with us, and we'll talk a lot more about green energy and also maybe some of the bubbles that he was alluding to. Now, later this week, the Exxon chief executive, Darren Woods, will be on Bloomberg. That interview, Thursday, on Bloomberg TV and radio. You don't want to miss it because it's also a conversation on renewable, green, and, of course, dividends. This is Bloomberg.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Bloomberg.
Shorting requires very good risk management skills. And you have to be able to change your mind quickly because otherwise you can get stuck in a position and be squeezed in the way we've seen. We're very proud of the way that we manage risk here. We have an excellent trading desk that we've really concentrated on using technology to make sure we can get out of positions very, very efficiently without the market seeing our footprint. And then shorting is a very valuable function to bring both to the market and to client portfolios.
That was Man Group CEO Luke Ellis discussing shorting in an exclusive interview with Bloomberg. Well, I want to get a quick check on the markets now because depending what side of the Atlantic you are on, the picture is looking a little bit different. In Europe, stocks holding on to gains, but with little under 4.5 hours to go until the U.S. Open, futures are pointing to a softer open after the best day for the S&P 500 since all the way back in June. Of course, the warning from China about risky assets looking like they may be in bubbles is weighing on risk appetite. That is weighing on oil as well, down potentially for a third day, though it may also be under pressure due to a stronger dollar. The greenback is up against nearly everything in the G10 space today. There are also a few more idiosyncratic micro stories going on beneath the surface. Zoom Video reported earnings after the bell. Its revenue view signaling growth is going to continue beyond the pandemic. That stock is up 8%. Rocket companies up another 10% in pre-market, looking to have a third day higher in a row. But two other stocks that reported earnings after the bell last night under pressure in the pre-market, C3AI and Lemonade, both down about 8% and 6% respectively, Matt.
All right, Kaylee, I have a chart here that I think is really interesting, especially for our guest, Mathieu. If you take a look at how much green energy shares have outperformed the Stocks Europe 600 and the MSCI World Index, it's pretty amazing. I've got the MSCI World in blue, the Stock 600 in white, and the SGI European Green Deal Index in, fittingly, green. The interesting thing, I think, is that there's a little bit of a spike you can see right near the end above the GTV there in your lower. That is the first trading week of December. And that's when, of course, the Democrats came into office, took over basically a very narrow margin in Congress. You've also got to push for a new Green Deal or even more of one here in Europe. So as politics starts to play along, I think markets are really encouraged, and I find it interesting, the outperformance, and I wonder if it'll continue. Francine?
Yeah, what a great chart for Mathieu Chabran. He's Tikehau Capital co-founder. He's still with us. And, of course, Tikehau just 2 weeks ago, I think, raised over 1 billion euros for a Green Deal fund. Mathieu, what, first of all, do you see putting in that fund? So are there targets, or is there something that you find attractive at the moment? And do you have a timeline for that deployment?
Yeah. No, thanks, Francine. I mean, this strategy is effectively focusing on three things, the clean energy generation, the low carbon mobility, and the energy efficiency. So, coming back to Matt's comment earlier, I'm not surprised, to see this chart, because we really believe we are at a crossroad. I would call it an historical crossroad. And there is a new paradigm for investors globally. Until now, you had to be profitable to be sustainable. I mean, today and tomorrow even more so, you will have to be sustainable to be profitable. And this shift that has started, and that, somehow the pandemic has accelerated for some reason, is a critical path for global asset managers. We're delighted at Tikehau to be showing the way with this €1 billion raised in private equity, because once again, Francine, Matt, I think we all have a massive responsibility here that many have been talking about, and it's up to us and asset managers to start deploying and allocating this 10% required of the global savings to tackle the climate change issue.
But Mathieu, where do you see it being deployed exactly? So first of all, what we all want to avoid, of course, is greenwashing. So where do you see opportunities where either opportunities that don't look too expensive or opportunities that no one else has seen yet?
I mean, once again, Francine, I'm coming back to my earlier comment about, when you use capital that you inject to a company, and here what we're doing with this strategy is effectively providing long-term capital to European SMEs active across these three verticals, I've just mentioned. This is effectively a growing business that is targeting at offsetting effectively some greenhouse gases, emission, this CO2 emission. Just to give you, a couple of data points, Francine. This fund is a billion fund. We have invested already 440 million euros across 6 European companies, in France, in Italy, in Spain, in Ireland. And just this investment has enabled to offset 1 million tons of CO2. And, because when we get into these matters, that it's, people don't really realize what is 1 million tons of CO2. It's by and large 1 million return ticket between London and New York, or Paris and New York. So it's not about, not having planes flying anymore. It's making sure that the way we generate, energy, we produce energy, effectively start offsetting those issues.
Mathieu, overall in private equity, do you see deals actually becoming bigger, and is that a good thing or is that a worry?
Yes, they're getting bigger because there is more capital, because there is more financing available. I don't know if it's a worry, but I tend to see that, if you're buying into growth, particularly, when you're providing real capital to, to once again, SMEs, it shouldn't always be about size. We saw that, in 2000, 2001, we saw that, right at the GFC. We were almost, seeing that right before the COVID, that this kind of, escalation to always go, for the bigger buyout, for the bigger deal that will be making the bigger headlines, most of the time is not the highest return at the end of the day.
Mathieu, thank you so much. Mathieu Chabron there, the Ticoho Capital co-founder, joining us this morning. Now, a little bit later today, I don't know if it's a friend or a foe, but certainly at Zoom, we use it almost, well, twice, 3 times a day. Kelly Steckelberg, the Zoom Video Communication Chief Financial Officer, joins us. That's later on, 5 p.m. in New York, 10 p.m. in London, and this is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Well, this is Bloomberg Surveillance, the early edition. I'm Francine Lachman, London, Matt Miller in Berlin, and Kaylee Lyons in New York. Now, Tom Keene, co-anchor of Bloomberg Surveillance Simulcast, joins us. Tom, I know you have some great charts. There's some Fed twists and stuff like that. But today, you focus on dollar dynamics.
We can look at the global litmus paper, which is always the U.S. dollar and the deep FX market. And it's really fascinating now about what is not occurring, Francine. It is a resilient dollar, and that is because, as we heard from Chinese leadership, there's some real worries about China, and you see it in the Pacific Rim. This is the Bloomberg Dollar Index. It's wonderful mathematics. It's a wonderful series. It's a really all-in-all global encompassing series showing a dollar range-bound and actually a stronger dollar over the last few days. But the heart of it to me, Francine, is the Pacific Rim just flat-out stalls.
Yeah, I mean, I love the fact that, you're focusing so much. I know there was one obscure but actually really interesting dollar zloty, chart that the Bloomberg terminal is putting on. So I know you look at that as well. What do you have coming up?
You're only doing dollar zloty because Miller's on the program. If Miller wasn't on the program, you wouldn't be talking zloty to save your life. Ibrahim Rabari.
Sterling.
Yeah, exactly. Ibrahim Rabari joins us with really a set of smart research notes over the last 5 or 6 days with Citigroup, and of course that will be on Dollar, telling us about the system. Speaking of the system, Sarah House will join us all encompassing, and David Costin, very optimistic and way out front on a more optimistic up 8, up 10, up 12% Standard & Poor's 500. He's provided real leadership in the stock market, and we do that with SPX 3885. We get an adjustment from Mr. Costin.
All right, Tom, thank you so much. I'm really looking forward to the conversation. Tom Keene, co-anchor there of Bloomberg Surveillance Simulcast. Now, there's a lot, of course, coming up from Bloomberg Surveillance, the early edition throughout the week. I know it's also going to be a busy week for what we're watching. Matt, what's on your radar?
I actually have to just bring up again the 10-year. It's starting to rise, and I know maybe it's boring if we're watching this every day, but you know, the chart I use at the top of the program, danger zone, the inverse correlation between the 10-year yield and stocks is at least a 4-year high, maybe more. So definitely keep your eye as the 10-year rises to 145.
All right, I know Kaylee will keep on the markets. And then, of course, there's that important story that Matt also mentioned, Italy likely to seek some extra stimulus as the virus outlook worsens. So we look at, of course, what the WHO is watching, which is these 5 new variants. We see whether the pandemic will continue to ravage, especially here in Europe, and what it means for some of these funds from the European Union. Now, more Bloomberg surveillance, of course, it continues. We watch the markets, we watch treasuries and Fed operations. This is Bloomberg.
Of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
What kind of leader are you?
I'm a leader that works on figuring out destinations that we should aim for, and then chooses the direction.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
to keep rising, but we need to do it in a slower, more orderly fashion.
The Fed really haven't pushed back in any real shape or form against those higher rates.
When things are really ripping from a growth or an inflation perspective, you can't say things don't look good.
The reopening is not even in the market yet. This value trade is still relatively new.
There's plenty of scope for more fiscal stimulus, and it looks like we are going to get it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Following a monster day of gains from New York City this morning. Good morning, good morning. Alongside Lisa Abramowitz and Tom Keene, I'm Jonathan Ferro. Tom Keene, the Chinese regulator, stepping in, and they are looking to tighten things up. I think we've got some sound problem with Tom Keene. Lisa Abramowitz, weigh in for us, please. That's been the story.
Yeah.
In the United States, is stimulus, stimulus, stimulus. In China, they're not willing to go the same way.
Which was raising a question about how much they're going to tighten. They raised questions overnight, the Chinese bubble story being very much front and center with respect to their property sector, but also their concerns about a bubble elsewhere in the world. John, I'm trying to figure out how they're hoping to jawbone the U.S. or Europe into acting right now at a time of real tenuous growth.
Let's kick things off with the price action this morning as we try and connect to Tom Keene in the other room at some point. Good morning to you all. We look like this Tuesday morning, shaping up as follows on the S&P 500. Futures down around about 15 points on the S&P. We're negative 0.4%. Tom, in the bond market, are you with us? Yields up 3 basis points on a 10-year to 144.
Good morning, John. My entourage just went by you there. You know, I just told them, I said, I have to have my camera guys here. I just can't exist. So it's good to see them wander by here. John, you know, really an extraordinary day yesterday. What I would go back to, John, as we saw that opening, was Tom Purcell modeling out 6% GDP, but saying everything could push higher. That, to me, John, is the overarching backstory with all the wonderful conversations we have ahead today.
Things in the last 24 hours flying in the equity market, Tom, really absolutely flying. And in the United States, good reason for it. J&J with the vaccine, I think we've had 50 million vaccinations in the United States of America. Really strong ISM print in the last 24 hours as well.
And John, I don't want to, you know, take the words out of Purcell's mouth in something that isn't official to RBC Capital Market, but he clearly alluded that 5 or 6% GDP could become Chinese-like in America. And you and I witnessed it. I got up from the surveillance nap yesterday, and there was a resiliency to the equity market we hadn't seen in ages.
Well, there's a weight to the tape this morning. NASDAQ futures down around about 0.4%, Lisa. Just a little bit of a pullback after a really big day yesterday.
Yeah, and a lot of people actually are attributing this to some of the bubble talk that we heard out of China. And there's a question of whether the U.S. will crack down on some of the frothy aspects of markets the way that China seems to be indicating that they will. 10 a.m. today, I'm watching this very closely. Senate Banking Committee is going to have a hearing on Gary Gensler's nomination as SEC chair. I find it very interesting to hear what he has to say about GameStop, about the retail trading, because there's really a tale of two sides here, John. You've got, on one hand, let retail traders get involved in something that's been a really hot area. On the other hand,